In 1979, the chairman of the Federal Reserve did something unthinkable. Paul Volcker raised interest rates to 20%. 20%. To understand how insane that is, if you took out a mortgage at 20% interest, you would pay more in interest than the house was worth. If you borrowed money for a business, the interest alone would bankrupt you before you could turn a profit. Volcker knew exactly what would happen. Businesses would fail, unemployment would spike, homeowners would lose their houses, entire industries would collapse. And he did it anyway. This wasn't an accident, this wasn't a mistake. This was a deliberate decision to crash the economy. Volcker looked at America's spiraling inflation, looked at the collapsing dollar, and decided that the only way to save the currency was to destroy everything built on it. Millions of Americans lost their jobs. The unemployment rate hit nearly 11%, the highest since the Great Depression. Farmers went bankrupt by the thousands. Latin American nations defaulted on hundreds of billions in debt. Entire economies across the developing world imploded. But Volcker saved the dollar. Inflation, which had been running at 15%, was crushed. The currency, which had been losing trust globally, was stabilized. And the Federal Reserve proved it was willing to do whatever it took, no matter the human cost, to maintain the system. This is the story of the most brutal decision in modern economic history. And it's a decision the Federal Reserve might be preparing to make again. This is the financial historian. Let's talk about the day one man chose to destroy the economy to save it. To understand why Volcker did what he did, you need to understand the crisis he inherited. By 1979, America was drowning in inflation. Prices were rising at 15% per year. That means if something cost $100 in January, it cost $115 by December. Your savings lost 15% of their purchasing power annually. Your wages, even if they went up, couldn't keep pace. This wasn't normal. For decades after World War II, inflation had been low and stable, 2 to 3% per year, manageable, predictable. But starting in the 1970s, something broke. The breaking point was 1971, when President Nixon took the dollar off the gold standard. Before that moment, every dollar was technically backed by gold. The government promised that dollars could be exchanged for gold at a fixed rate. That promise limited how much money could be created. But Nixon closed the gold window. From that moment, the dollar was backed by nothing but trust. And once that anchor was gone, the temptation to print became irresistible. The government printed money to fund the Vietnam War. It printed to cover rising social spending. It printed to stimulate the economy during recessions. And every time it printed, the value of each dollar declined. Then came the oil shocks. In 1973 and again in 1979, OPEC cut oil production and prices quadrupled. Since oil touches everything, transportation, manufacturing, heating, when oil prices spike, everything gets more expensive. The combination was toxic: a currency unmoored from gold, a government printing to cover deficits, and energy prices exploding. Inflation spiraled out of control. By 1979, Americans were panicking. People were buying gold, silver, real estate, anything to get out of dollars. Foreign governments were losing faith. The German mark and Japanese yen were strengthening as the dollar weakened. If the trend continued, the dollar would lose its status as the world's reserve currency. That's when Paul Volcker took over the Federal Reserve in August 1979. He was 6'7", imposing, and he had a reputation as a hawk, someone who believed inflation was the greatest threat to the economy and had to be stopped at any cost. And he meant any cost.
Volcker's solution was simple and brutal: choke off the money supply by raising interest rates so high that borrowing became impossible. Here's how it works. The Federal Reserve controls short-term interest rates, the rate at which banks lend to each other overnight. When the Fed raises rates, borrowing becomes more expensive across the entire economy. Mortgages get more expensive. Business loans get more expensive. Credit cards get more expensive. When borrowing gets expensive, people and businesses borrow less. They spend less. Demand falls. And when demand falls, prices stop rising. Inflation dies. But there's a cost. When people stop borrowing and spending, businesses lose customers. When businesses lose customers, they lay off workers. When workers lose jobs, they spend even less. The economy contracts. You get a recession. Volcker knew this. He knew that raising rates would trigger a recession. But he believed inflation was a worse threat. Inflation, left unchecked, destroys currencies. It erodes trust. It leads to hyperinflation, to economic collapse, to political chaos. So in October 1979, Volcker announced a new policy. The Fed would focus on controlling the money supply, and it would let interest rates rise as high as necessary to stop inflation. Within months, interest rates exploded. The federal funds rate, the rate banks charge each other, went from 11% to 20%. 20%. Mortgage rates followed. By 1981, the average 30-year mortgage rate hit 18%. If you wanted to buy a house, you were looking at interest payments that would double the cost of the home over the life of the loan. Car loans became unaffordable. Small businesses couldn't borrow to cover payroll. Farmers, who rely on seasonal loans to buy seed and equipment, were crushed. Credit card rates hit 25% or higher. And Volcker didn't flinch. When unemployment started rising, when businesses started failing, when politicians and business leaders begged him to cut rates, he refused. He said the pain was necessary. That inflation had to be killed, no matter the cost. Think about the arrogance of that. One unelected bureaucrat deciding that millions of people losing their jobs was an acceptable price to pay. That entire industries collapsing was necessary. That families losing their homes was the cost of stability. And yet, he was right. Because if he hadn't acted, the alternative would have been worse. Let's talk about what 20% interest rates did to ordinary Americans, because the numbers don't capture the devastation. The unemployment rate, which had been around 6% when Volcker took over, climbed to nearly 11% by 1982. That's 1 in 9 American workers without a job. In some industries, it was worse. In manufacturing, in construction, in agriculture, unemployment hit 15–20%. Entire towns built around a single factory watched that factory close. Steel towns in Pennsylvania. Auto towns in Michigan. Textile towns in the South. These weren't just job losses, they were community deaths. Farmers were hit especially hard. Agriculture depends on credit. Farmers borrow in the spring to buy seed, fertilizer, and equipment. They repay the loan after harvest. But when interest rates hit 20%, those loans became death sentences. Thousands of family farms went under. Auctions became common, entire lifetimes of work sold off to pay debts. Suicides among farmers spiked. The agriculture industry, which had been stable for generations, was gutted in 2 years. Homeowners faced a similar nightmare. If you had an adjustable rate mortgage, your monthly payment could double or triple as rates rose. Families who had been managing suddenly couldn't make payments. Foreclosures exploded. And here's the cruelest part, while ordinary Americans were suffering, the wealthy did fine. If you had money, 20% interest rates were great. You could park cash in treasury bonds and earn a 20% return, risk-free. The rich got richer while the middle class was destroyed. This is always the pattern. When central banks decide to fix the economy, the cost is borne by workers, by families, by small businesses. The elites, the ones with assets and access to capital, survive. They profit. But Volcker didn't care about the human cost. He cared about the currency. And by that measure, he succeeded. By 1983, inflation was dead. It had fallen from 15% to under 4%. The dollar, which had been in free fall, stabilized and strengthened. Foreign governments, which had been fleeing dollars, started buying them again. Volcker had won. He had saved the currency. And the cost was 2 brutal years of recession, millions unemployed, industries destroyed, lives ruined. But here's the question nobody asks: Was there another way? Volcker and his defenders say no. They argue that inflation had become so ingrained that only shock therapy could kill it. That a slower approach would have failed, that people had stopped believing the Fed would act, and only drastic measures could restore credibility. Maybe. But let's be clear about what happened. The Federal Reserve, an unelected institution, chose to deliberately crash the economy. They chose to prioritize the value of the currency over the livelihoods of millions of people. And they got away with it because central banks are insulated from democratic accountability. You didn't get to vote on whether Volcker should raise rates to 20%. Congress couldn't stop him. The president couldn't fire him. The Fed is designed to be independent, which means it can make decisions that would be political suicide for any elected official. And that independence is sold to us as a good thing. We're told that monetary policy is too important, too technical, to be left to politicians who care about re-election. We're told central bankers make rational, apolitical decisions for the long-term good. But the Volcker shock exposes the lie. There was nothing neutral about choosing to destroy jobs to save the currency. That was a political choice. It was a choice about who pays and who benefits. And the people who paid had no say in the decision. The Volcker shock didn't just hurt Americans. It triggered a global debt crisis that devastated the developing world for a decade. Here's what happened. In the 1970s, Latin American countries, Mexico, Brazil, Argentina, and others, borrowed heavily in dollars. Western banks, flush with petrodollars from the oil shocks, were eager to lend. The money funded infrastructure, industry, social programs. The borrowing seemed safe because interest rates were low and inflation was high. If you borrow at 8% and inflation is running at 10%, the real value of your debt is shrinking. You're effectively getting paid to borrow. But when Volcker raised rates to 20%, everything flipped. Suddenly, these countries were paying 20% interest on their dollar-denominated debt. And because their revenues were in local currencies, pesos, reais, cruzeros, but their debts were in dollars, currency devaluations made the burden even worse. In 1982, Mexico announced it could no longer service its debt. Brazil followed. Then Argentina. The entire region was on the brink of default. The result was what became known as the Latin American debt crisis, or that lost decade. Countries were forced to slash spending, raise taxes, devalue currencies. The International Monetary Fund stepped in with loans, but those loans came with brutal conditions: austerity, privatization, opening markets to foreign corporations. Economies across Latin America contracted. Poverty soared. Political instability followed. And the debt burden took decades to resolve. Who benefited? The same Western banks that had made the risky loans were bailed out by the IMF. They didn't lose money, they were made whole by international institutions funded by taxpayers. Meanwhile, ordinary people in Latin America paid the price. This is the pattern you need to see. When central banks in rich countries make decisions, the consequences ripple globally. And the cost is always borne by the weakest, the poorest, the ones with no voice and no power. The Volcker shock revealed something that had always been true but was rarely spoken: the Federal Reserve is more powerful than the president, more powerful than Congress, more powerful than any democratic institution. When Volcker raised rates, President Jimmy Carter was furious. The economy was tanking in an election year. Carter knew the recession would cost him re-election. He begged Volcker to back off. Volcker refused. Carter lost to Ronald Reagan in 1980, in part because of the economic pain. But even Reagan, once in office, couldn't control Volcker. Reagan's advisors pushed for lower rates. Volcker ignored them. The Fed was independent, and Volcker used that independence ruthlessly. The message was clear: elections don't matter when it comes to monetary policy. You can vote for change, but if the Fed decides the economy needs to crash, the economy will crash. This should terrify you. Because it means that the most important economic decisions affecting your life, whether you can get a loan, whether you keep your job, whether your savings hold value, are made by people you cannot vote out of office. The Federal Reserve is, by design, insulated from accountability. Its governors serve 14-year terms. The chairman serves for years, but can't be removed except for cause. And cause doesn't include made a decision voters hate. The justification is that monetary policy requires long-term thinking, and politicians only think about the next election. That may be true. But the cost of that independence is that the Fed can impose massive pain on the population without facing any consequences. Volcker retired in 1987, lauded as a hero. He was celebrated for his courage, his resolve, his willingness to make tough decisions. And in one sense, he earned it. He did save the dollar. But ask the millions who lost their jobs, the farmers who lost their land, the families who lost their homes, whether they see Volcker as a hero. Ask the people in Latin America who lived through the lost decade whether they're grateful for his courage. The truth is that the Volcker shock worked if your measure of success is the value of the currency. But if your measure of success is the well-being of ordinary people, it was a disaster. And the scariest part? The Fed is willing to do it again. If the Volcker story sounds like ancient history, pay attention. Because the Federal Reserve is running a version of the same playbook right now. In 2020, during the COVID pandemic, the Fed cut interest rates to zero and printed trillions of dollars. The justification was that the economy was collapsing and needed support. But printing trillions has consequences. By 2021, inflation started rising. By 2022, it hit levels not seen since the 1980s. 9% annual inflation. Prices for food, gas, rent, everything, soaring. So what did the Fed do? They raised rates. From 0 to over 5% in less than 2 years. The fastest rate hike cycle in decades. Sound familiar? The Fed is trying to kill inflation the same way Volcker did, by making borrowing expensive, by cooling demand, by pushing the economy toward recession. And just like in the 1980s, the cost is being paid by ordinary people. Mortgages that were affordable at 3% are now unaffordable at 7%. Home sales have collapsed. Small businesses that borrowed cheap during the pandemic are now struggling with higher debt costs. Layoffs are increasing. Tech companies have cut hundreds of thousands of jobs. Regional banks collapsed in 2023 because rising rates destroyed the value of their bond portfolios. The cracks are spreading. But the Fed insists this is necessary. That inflation must be controlled. That pain now prevents worse pain later. Maybe they're right. But recognize what's happening. Once again, unelected central bankers are choosing to prioritize the currency over people's livelihoods. Once again, the cost is borne by workers and families, while the wealthy, who own assets that rise when rates are high, do fine. And once again, you have no say in the decision. So how do you protect yourself when the Federal Reserve decides your job, your savings, and your future are acceptable collateral damage in the fight against inflation? First, understand that the Fed will always prioritize the currency over you. That's not cynicism. That's their mandate. They care about price stability and the financial system, not about whether you can pay your mortgage. Second, don't assume stability. When rates are low, don't borrow as if they'll stay low forever. When times are good, don't assume they'll stay good. The Fed can and will pull the rug out when they decide it's necessary. Third, own assets that do well when rates rise. Cash in high-yield savings when rates are high. Short-term bonds that can be rolled over at higher rates. Avoid long-term fixed income that loses value when rates spike. Fourth, build resilience. Skills that keep you employed even in recessions. Emergency savings that let you survive unemployment. Debt levels you can manage even if rates double. Fifth, recognize the pattern. Every decade or two, the Fed tightens until something breaks. In the 1980s, it was Latin America and American agriculture. In 2008, it was subprime mortgages. In 2023, it was regional banks. The question isn't if the next crisis comes, it's what breaks and whether you're exposed. The Volcker shock taught us that the Federal Reserve is willing to crash the economy to save the currency. And they will do it again, whenever they decide it's necessary. The only question is whether you'll see it coming. In 1979, Paul Volcker raised interest rates to 20% and deliberately crashed the American economy. Unemployment hit 11%. Farmers lost their land. Families lost their homes. Latin America entered a lost decade of debt and poverty. And Volcker was celebrated as a hero. Because he saved the dollar. Inflation fell from 15% to under 4%. The currency stabilized. The Federal Reserve proved it would do whatever it took, no matter how many people suffered, to protect the system. This wasn't democracy. This was a single unelected bureaucrat deciding that millions losing their jobs was an acceptable price. And because the Fed is independent, nobody could stop him. The lesson is brutal but clear: the Federal Reserve is more powerful than any elected official. And when they decide the economy needs to crash, it will crash. Right now, the Fed is raising rates again. Inflation is rising, and they're tightening to kill it. The same playbook. The same logic. The same willingness to sacrifice jobs and livelihoods to save the currency. Layoffs are spreading. Banks are failing. Mortgages are unaffordable. And the Fed says this is necessary. Maybe it is. But understand what's happening: you are being asked to pay the price for decisions made by people you cannot vote out. And when the pain comes, those people will be fine. They always are. The Volcker shock worked if you measure success by the value of the dollar. But if you measure it by the lives destroyed, it was a catastrophe. And it's happening again. History doesn't repeat, but if you ignore it, it will crush you all the same. If this gave you a new perspective, hit subscribe. History has the answers, I'll show you where to look.